Welcome to Cambridge House Live. I'm Vanessa Collette at the World Resource Investment Conference. Joining me today is Peter Murray, Vice President of Proactive Investors. Welcome, Peter. Great to have you here with us.
Thank you for having me.
Could we start out with just talking about your macro overview of what you see going on in the markets generally?
Yeah, you bet. Really, I think what you see is almost kind of a tale of two markets. If you look at the big caps in the United States, you look at the Dow Jones Industrials, you look at the S&P 500, which is kind of the more so the benchmark that the institutions and everybody uses to measure the larger overall markets. As you know, it's going to all-time highs. It's reached all-time highs, and it just keeps running. The leg up on the Dow right now has been running, for a couple of months since breaking to a new all-time high, and it doesn't look like it's going to stop. You look at, say, the venture market here in Canada, and it's completely different. Far from being at an all-time high, it's a good 60% off of its all-time high. And, it looks like it's remaining weak. So I don't really think it's something that we've ever seen before, and it's a little bit troubling because usually the markets move together. Now they're moving in two different directions. I think there's some opportunities there, but, the path forward isn't clear for our venture market for sure.
So, speaking of the venture market, can we narrow it down to the resource sector? What do you think is happening there?
Well, again, prices are down, even though the commodity prices themselves are holding up. We've had a little bit of a downturn in gold, but at around $1,400 this morning, it's still holding up. Copper at about $330, $340. It's not that far off of its all-time high. Oil, the WTI price, it's still up above 90. It's still quite strong. So you have to ask, why are the prices down? And I think one of the reasons is that the costs are going up. So when you look, for example, at oil, a lot of the oil that is going to be coming out of the ground in the future is going to be from deposits that are, 2 and 3 kilometers under the ocean. They're very expensive to get out. There's been a lot of talk about shale oil, shale gas. These are very expensive technologies. You have to go down several kilometers, and then you have to go laterally several kilometers, use 20 stages of frac. It's relatively new technology, and it's quite expensive. If you look on the mining side, costs are going up there. So you may find a deposit, but the costs of actually getting your metal out of the ground are going up. So what that means is that margins are shrinking, and of course, what moves stock prices? It's the margins, and that's having a big impact on both the TSX and the venture exchange in terms of depressing prices. And
with gold moving down, it's left a lot of investors confused as to what's happening. What do you see happening there?
Long term, both for silver and gold, the precious metals, I'm quite bullish. I think one aspect of the gold market and gold trading that people don't realize is that it's not as liquid as people think. So quite often when we get big moves, part of it is fundamentally driven, but some of it is also what I would kind of term the mechanics of the market. Once a move, if it happens in a single day, moves beyond say $20, $30 range, there's not that many bids there. If it's going down, there's not that many buy orders there. So, computerized trading will kick in, sell orders will kick in, and there just isn't the critical mass of buy orders there to hold it up. So then the market can begin dropping more so on mechanical factors than actually, fundamental factors. I also think that it's quite reasonable for gold to have stepped back somewhat here. We've had about 4 or 5 months of different people in the Federal Reserve, and they started to talk about tweaking QE, tweaking the QE, maybe even ending it at the end of the year. Well, that's what's holding precious metals up. So they haven't officially made any changes yet, Vanessa, but when they start talking about it, they're telegraphing what they're going to do. So I think the gold price at around $1,400, $1,300 to $1,400 is pretty fair.
So what do you think overall of the Fed's quantitative easing policy and the fact that they've been continuing to do it, even though they're saying they might be planning on tapering it?
Right. Well, they've, this is notionally the third round of QE. They've shut it down before, and they've had to come back and do it again. I know a lot of people complain about quantitative easing. I guess history will prove Bernanke right or wrong, but that is what has been holding the markets up, holding interest rates down, we're talking before about why the S&P is up and why the Dow is up. one of the mistakes that people made coming out of 2007, 2008 was to trade the economy, rather than earnings. And so what I mean by that is the economy was weak and people were saying, oh my goodness, it's not going to come back, I better get out of stocks. But what it was actually doing, and QE was one of the catalysts there, it was setting up an environment for companies to do well by lowering interest rates, by forcing them to cut costs, by letting people go, thereby upping their margins. It actually created a really good environment for profits, and QE was part of that. So they will try to dial it back and see if the economy can, run on its own. And if it can't, they'll just dial it up again. But, careful what you wish for, because it's helping more than hurting us.
Right. You've worked all over the world. I think specifically in Japan. Tell us what's going on there.
Really interesting case there. The Japanese yen was at a record high for, quite some time until about October, November of last year. And you can argue why it was at an all-time high. It didn't really make a lot of sense fundamentally because the economy was weak. You had, some of the most famous and respected companies in the world like Panasonic, Sharp, and the list goes on, and they were teetering on the brink. And a lot of that was because they were just uncompetitive because of the currency. You had a new prime minister come in, Prime Minister Abe. He replaced the central bank chief, chose him very carefully, Mr. Kuroda, and they immediately let the market know that, look, we're going to drive this thing the other way. So it's gone from about 75 yen to the US dollar to just over 100 yen to the US dollar. There are people complaining about that, saying it's currency manipulation. Actually, if you look back historically, 100 yen to the dollar is still quite a strong level for the yen. In my opinion, it's quite a fair level for the yen, both for Japanese companies and companies that would be competing against them. It levels the playing field a little bit. And as you look at the most recent quarterly earnings coming out of Japan, it really, really has helped the companies there. So I really like what they've done. I know, some people will not, but I think what they've done is fair. There is a risk there that, it could get a little bit out of control. If their interest rates started to go up, people lost faith in their bond market. I think the currency is going to go down a little bit more. But right now, I think they've got it under control, and I support what they do.
And do you think it'll work?
It is working. Yeah, it is working. The thing that puzzles me is that it took the leaders of the country so long to figure out that if they didn't do something, their biggest companies were going to collapse, and then what do you build your economy on? So no, I really support what they do, and it is working.
Moving on to the general markets, how do investors make money right now?
Well, let's think about one of the oldest tenets in the stock market, which is buy low, sell high. We're here at the Cambridge Mining Show, and given where the venture exchange stands and where some of the junior stock prices are, they're definitely low. There's some good opportunities out there, but I think that investors, when we invest in the venture market, we're looking to make big gains. We're looking for that growth. And I think that you really, right now, you also better throw in a good dose of what I would refer to as sustainability. The market's bad now. The conditions for raising capital are bad, and you don't know how long that's going to last. So as you're having a look at what you might want to buy in the venture market, you should be looking at things like, you've got to make sure there's a good team. You better look at the financials and make sure that the sustainability is there. A lot of people don't get on Sadar, download the financial statements and have a look. It doesn't take very, very long to do it. You have a look at the balance sheet. That's going to give you an idea of the solvency of the company, its ultimate sustainability. You have a look at the income statement. You can see what management is spending money on. Is it going primarily towards salaries and travel, or is a lot of money going into the ground? How responsibly are they running the company? And based on the condition of the balance sheet, what they're spending the money on and the pace that they're spending it, do they have the sustainability there? If they weren't able to raise capital for, say, the next 12 to 18 months, where would they stand? Always read the notes to the financial statements, because that's where all the secrets, if you will, are not hidden. They're there. That's what disclosure is for. But that's where a lot of the details that you need to know are. So, again, choose companies with good people, good structure, good projects, but make sure they have the sustainability. I think another theme that with the broader markets at all-time highs, again, the up leg in the Dow, the current one, is so long that I can see it stepping back a little bit here. look for things that kind of have a little bit of the extreme to them. So I'll give you a couple of examples. If you look at the second half last year, if you look at Manulife, one of the most well-known Canadian companies, at the time it was the most heavily shorted company in Canada. Now, life co-earnings are driven primarily by the yield curve, where short-term interest rates are versus long-term interest rates, and is that curve steep or is it flat? When it's flat, the life co's earnings tend to be lower and their stocks tend to be lower. So at that time, about 10 months ago, the yield curve was about as flat as it was going to get, but it had this massive short position against it. I wouldn't want to be short when something's already been driven down and the fundamentals probably aren't going to get any worse. 9 months later, where we stand, the stock's up about 50%, and you would have had about a 5% dividend along the way on that, on an annual basis. Getting back to Japan, the currency was at an all-time high there, or it was the strongest it's ever been. Companies were really compromised by that. Something had to break, and it wasn't going to break stronger, it was going to break weaker. So somebody could have gone into, say, a currency hedged ETF on the Nikkei, and about 6 months later, you're up huge on that because the stock market has responded to the better outlook for earnings of Japanese companies by the move in the currency, and it's way, way up from about, the mid-8,000s, and it's up around, 14,500 now. You could have captured most of that move in 6-7 months.
So does proactive investors provide some tools to do what you're talking about?
Oh, you bet. For people who don't know what proactive is, you kind of think of us as the Bloomberg for the $500 million and under market cap. So we cover the broader markets. We cover companies in the S&P and the Dow. We cover oil. We cover gold. But our kind of sweet spot, our core, if you will, is probably companies with market caps of, I'd say, about 40 million to 300 million. We are usually the only media service that will be sitting in on conference calls held by these companies. We have some relationships with a lot of the Canadian investment banks. They send us their research, and we write on that research. Most retail investors and a lot of professional investors will not get that research. We do. We write on that, and we get it out, and it saves you from having to read a 20, 30-page report. We're going to give it to you in a page and a half. All the salient points, and it saves you time. For those who don't know, again, proactive, we get about 2 million visitors a month. That works into somewhere on the order of about 25 million page reads. So we're a big service. We have about a third of our readership in North America, a third of it in the UK, and about a third of it in continental Europe, Africa, and let's call it Australasia. So we're quite global as well.
Well, thank you so much for joining us today, Peter. It was a pleasure having you here, and I hope that you enjoy the rest of the conference.
Great. Well, thank you very much.